everybody. Welcome to today's masterclass. I forget what we call it. Mastermind Impact Masterclass. We are having Catalina. She is a good friend of mine and founder of Loansense. We're going to be talking about student loans and reaching the next generation with those who have student loan debt. Super excited about the conversation. We are having a little bit of technical difficulty with Kat joining, so this will just take us a second. So one of the reasons why I thought this was great timing to have this conversation is that we just released the 2025 Next Gen Homebuyer Report. I believe it was last month, and one of the data points in there is that 17% of Next Gen homebuyers said that they had student loan debt. And actually, I'll pull up a slide that shares this. And I was looking at some additional data that was talking about, so here we have, student loans, 17% said that was part of their debt currently, and this is with 1,000 millennial and Gen Zs across the country. What we see from the NAR data, which I'll actually share this report. This is super interesting. If anyone is interested in working with people with student loan debt, which I highly recommend, there's huge opportunity here of people. There's a lot of great data here that's recent from the National Association of Realtors, and I pulled out an interesting point here that let's see, it was highlighted among first-time homebuyers. 36 reported that student loan debt prevented them from making a down payment on a home. And I know there's some other data out there about perception, but we know that there's a lot of people that don't know that they would be able to qualify, or if they had an appropriate repayment plan or program or product in place, it would allow them to, of course, qualify when they otherwise wouldn't be able to qualify. And one thing I wanted to note here is that number jumped up to 52% for Black first-time homebuyers. So there's a significant gap here when it comes to racial inequality, and then of course with millennials and Gen Z, this is even more prevalent. And then in this chart that I just kind of screen grabbed from the NAR report, it was 24% said that those who have not paid off their student loan debt, they would put that money towards a home, purchase of a home. So huge opportunity, especially as we are thinking about First Home IQ and our mission to bring homeownership, education, resources, and inspiration to the next generation. So with that, I wanted to open up a conversation. Let's see if we can get Kat over here spotlighted. There we go. There you are. Hi, Kat. Thanks for being here for the conversation, and glad we got you on camera.
Yeah, absolutely. Absolutely. Yeah, thanks for having me here. Happy to take it in any direction. There's been tons of student loan updates, tons of questions in our inboxes as well as LinkedIn. Happy to go over that. But I do want to say that there's also 17 million student loan borrowers who are in the prime purchase demographic who are renting. So the reason that number is so significant is because it speaks to the psychological barrier that I don't think people talk about as much, because the majority of 50% of the borrowers plus 50% plus that we serve have been declined for mortgage in the past. So there's this psychological component, or there's also this fear of trying again for some people, or I've already tried, I guess I need to wait for 10 years or whatever the delays is a psychological response. And so there's a reason that there's 17 million. Obviously, we have a housing shortage, inventory shortage, multiple things happening, interest rates that are going down a little, but there are 17 million. So if people are working in their local markets, what does that number, look like in your market? And how do you speak to this being just a big pain point and being able to address it? So actually, I do have a freebie to give out if people are interested in how to talk to borrowers about it. They can literally put their own logo, their own picture, it's a real life testimonial from an LO that they can highlight how they can help. Oh, they love freebies. Great. So we have a freebie that you can go in and duplicate. And there's already a few LOs who duplicated it and left it in there as an example for other LOs to do. So I'm happy to share that. But yeah.
Okay. So what I want to get out of this conversation is one, I want you to definitely talk about some of the updates that would be relevant for people to know, but I'd also love for you to share some stories of like how loan officers are getting new business by, through this approach, understanding some of this. Um,
Yeah, absolutely.
for us to talk about some of the mistakes that loan officers often make, some of the best practices. And then out of this, definitely the freebie, awesome. But it'd be cool if we could also collaborate on creating kind of an email template or something like that where we could put this in the First Home IQ.
Oh yeah, we have tons of templates already. So yeah, happy to do that. So yeah, let me answer. Okay, so should I do update first or kind of how LOs?
Let's start with I'd love to have you talk about, because I mean, you touched on this a little bit, but I know that many next gen homebuyers they're really already intimidated by the mortgage process, like super. I mean, that psychological barrier is there even without the student loan debt. You add the student loan debt, and there's a huge, extra barrier there. So I would love to have you talk a little bit about how loan officers can approach those conversations, or some of the ways that they can build trust where where there hasn't been a lot of education around this.
Okay, so building trust, I think with student loan borrowers, start with, hey, I think generally from what we found, the loan officers that are the most robust at sending borrowers through our program, and what they do is like, I'm here as an advisor. It doesn't matter if you're not ready to buy today. Let's have a conversation because there's things you could do today that will get you ready, that will put you in a better position. So let's talk. Like, what are you worried about? Tell us what your biggest work concerns are with your financial situation, and just let them talk and listen. And that's where being like this term of being a mortgage advisor is really important versus like a loan officer. It's not a transactional, but creating, I'm like your advisor. So let's talk. What are your biggest fears? Right. And if they have a lot of student loan debt, you'll often hear that. It's like a random thing across regular media of people that aren't even in financial services, or like it's mainstream. Like, now I have all this student loan debt. Like, their issues and what they're worried about, or their concerns, or their budget shortages each month, they'll express that. So the biggest way I find to build trust is, hey, what are some of your biggest concerns? Like, I'm really great. Like this LO that's really good at sending people, he's always like, I have creative ways to get any payment counted towards your rent. I got this guy's liquor bill counted, like payments towards his liquor bill counted, to build his credit, and he like lightens the mood, just showing how even he helps people's bad habit build their credit. Something like that just doesn't put shame on anything that they may feel shame over, right? So I think just starting with how can we start this conversation? It's not about submitting an app. It's about, what are your biggest concerns? Let's address them now. And LOs that are most robust in using our service are the people that are tuned to that and being like, okay, I have a partner who can help you with these specific things. And in our freebie that we will put a bit.ly link to access, that Loansense does better than anybody else beyond what people can do for themselves, is we will work with a loan officer to understand exactly what a student loan payment needs to be in order to qualify. And we will 90% of the time get a borrower under that, using either their income or regardless of their income. There are self-imposed payment plan options we can put people into, but we will often get them lower than what they can do themselves by submitting different proofs of income. So we add that extra expertise that loan officers don't have to become experts at, because this is what we do day in and day out. So if someone's like, I have to get on the phone with Mohila or Ed Financial for 3 hours because those are the wait times since these budget cuts, we can just eliminate that. They don't need to do that. Yes, that like just cut out the 3 hours or cut out the need to try to explain what to do. Like, we just cut that out for them and make the process of, oh my God, I can't get a hold of them, what do I do? To, this is exactly what you need to do. we're going to submit this. We're going to submit this. This is what your LO says. So this is what we're going to submit, and just take out all the, oh my God, I don't know what to do because these people aren't answering their phones right now. Right. So we just take that out, create better outcomes. And we work as partners with lenders to not just do that process, but make sure we're getting the right docs for mortgage close.
Mhm. So, and what you have seen as really working well for people, I mean, this is the part of the conversation and how people are, starting that, but um, how do they reach them initially? Are you seeing people go to their database and talk about educating
Yeah.
your
So
kids?
that's a great question. So what we can help lenders do, and we do it more at an enterprise versus an LO level, but it could still be done. We've had some broker level or branch level, um, is they'll send us, and I can show what this looks like. They'll send us, hey, this is everybody we've spoken to in the last 6 months that didn't move forward. And they'll data dump it. We can crunch it and we can estimate exact savings and we can give a script. So it's a great way to prospect and to have a reason to reach out again. Hey, we have this partner loans. We have this. Well, you don't have to introduce the partner right away, but the script is such that, hey, from the information you submit, we see that there's an opportunity with all this pause and all these issues going on with student loans to get into a better plan and qualify for more home. Are you interested in learning more about it? It's a way to regenerate the conversation about their interest in buying again. Now that rates have gone down a little, that's another great thing to start striking the conversation. But yeah, just go back in the last 6 months to even a year of everyone that did not move forward or did not close. You just running that data and give a script and give emails, right? So you don't even have to generate the email, but or even a simple text like, hey, we're looking back at ways to help borrowers. We see there's opportunity to help better manage your student loans, your debt, and see how we can get you back on the pathway of buying. Can we rediscuss your goals again?
Yeah.
Do you have plans to buy? Are you relocating? We'd love to help you figure out what's best, right? And we have those kind of scripts. So that's a great way to go back to your database. We also have marketing assets to speak to the pain points as well if you're trying to speak to borrowers. And then lastly, if you put on first time buyer webinars, you put on informational sessions with real estate agents, our product, honestly, people can sign up for free at lender.myloansense and have a free estimator that they can go and speak to realtors to differentiate themselves as well, to let them know if people come in and express, because people will tell realtors their issues too. Sometimes their realtors are their friends, ahead of even knowing an LO. You can let your realtor partners know about this product as well and give them your specific link to, when they pull up the Loansense product, it will say your name, your NMLS, your email address, and your phone number. So their estimator will have you as the LO front and center when your realtor partner is helping get this information out if they hear people with this pain point as well.
Okay, cool. And I want to put a pin in this, but I also think that we've done a challenge with First Home IQ. Tim Brahim kind of started this a few months ago when we were talking about going to your database and educating their kids, and I think having, hosting a webinar on this topic with a realtor partner or whatever, leveraging the tool could be a really great way to say hey, if you have kids that are in college, going to college, have student loan debt, let's talk about this, before they might feel that way. But I want to come back to if you could just share really briefly what Loansense does exactly. We, have a general understanding, but that would be helpful for people.
Yeah, and then I'd love to get into some of the huge LO issues that are coming to us a lot lately too, because I think it's a huge thing that originators are thinking about. What do? We basically estimate how much we can reduce student loans and boost purchase power by. And by doing that for borrowers led by student loan debt, because we're enrolling them into federal programs, and we also have the best in class refinance rate by the state of New Hampshire with muni bonds. So the lowest interest rates for private student loans on the market with the highest approval rate, 65%. No online refinance, you'll find that. So we have that for private, and we have the best in class. We're like a turbo tax for student loans We will enroll them into any type of forgiveness program. We will enroll them into income driven, any program they can qualify for, and we will get the docs for mortgage close. The best part is we give you free products. We give you free products to talk to borrowers better. And we work in conjunction with you. So if you tell us if they get over a $200 payment, they cannot buy a house, we will hear that and we will work the best we can to get them to that point with options of this is what you do to close. This is what we could do post-close, right? All states, yes, all states, because it's federal programs. Federal programs. So I hope that answered a question I saw ping up. Do you charge? Yes, we charge. We could charge. Do we charge the borrower? So when you sign up for a dashboard, we give an option to every LO if they want to pay for their borrower, if they want the borrower to pay. So if you want the borrower to pay, that's fine too. It's $249 or 3 payments of $89. So they can choose one of those options, but our average savings is more than the payment they make to us. So, and they get a free plan. So nobody pays us before they know what the plan's going to be. So again, and we have a money back guarantee. So people aren't coming to us. We estimate the reduction. We're very close to what the federal government says. And we don't charge people if there's no possibility to get a reduction, if that makes sense. So they get a free plan, essentially.
So, do you want to share a little bit about the student loan updates and
Yeah, absolutely.
Absolutely.
So number one, because Biden did what's called a transition into repayment period and basically saying no servicer should report any late payments or missed payments to the credit bureaus. And so he did that on ramp into repayment, it was called. Ended January 1. So what's happening now is everybody who didn't make those payments, who wanted to take an extended pause, now all those dings are catching up to them. And so borrowers who had like a 700 credit score January 1 now have a 560 credit score. And lenders are like, wait, this person's in process. Like, why did their credit score drop? Why are there all these issues? It's causing issues with our ability to originate. Why are specific items coming back with saying that there's more trade lines than their statements from their services are saying? Why is that? What's happening? So there's trade line issues and credit score drops. And so that's a huge issue because obviously if your credit score drops, then if it drops below ability to originate, that's a huge bad error. Also, if it's different trade line reporting than what servicer statements are, then that's also an issue because we have to have an alignment in order to originate, right? And it's part of being guideline compliant, right? So Loansense has solutions to all of that. We deal directly with servicers to correct. A lot of borrowers aren't late because they just decide, I don't want to pay my student loan, but oftentimes they're late because there's been a servicer change. They have an old address from when they were like their first house when they were in college. They never updated the address. They never updated the email they used when they were in college. So they're not getting notifications. They're not getting the notifications mailed or emailed that their payment's starting, or they'll get 4 notifications of different dates. So we use the servicing transfer and the servicing issues as a reason that the servicer should take off these initial late payments and basically say, we will be paying on time. We set up auto pay already, to remove those issues with the credit. Another thing is trade line issues. If there's a trade line issue between the credit report and what the statement says, it's because a lot of loans are in process of being forgiven because they've already made their 120 payments or whatever. And it will show up on the credit, but it won't show up on the state servicer statement, right? So then we need to just ask the servicer for specific documentation stating that those loans will be forgiven. And so it could get basically nixed out of the DTI formula on the lending guidelines, but we need to ask for very specific documentation. And we also do that. So those are some issues with reporting on the credit that you'll see more and more borrowers are getting dinged because of missed or late payments that we can help correct without dealing directly with the credit bureaus because we're not a credit repair. We deal 100% with student loan servicers. And that's a big update on on the credit issues and trade line issues. But of course, I'm happy to take any questions around that. Other
Yeah, I
items.
was gonna say, if anyone has questions that, around student loan debt or helping more borrowers qualify, please chime in. I have more questions that I want to get into around even like some of the myths that exist around student loan debt. With a lot of millennials and Gen Z, rely like one of the big statistics we had from the report is how much people rely on YouTube and TikTok for their education. And so, I'm wondering from your perspective, what are some of especially with some of the updates that have happened, there's been a lot of confusion for people that hold student loan debt. And I'm sure for loan officers who are working with them, are there any big myths that come up a lot that you'd like to kind of debunk around that?
Yeah, myths like, yeah, there's a huge one that was going all over social media. Like, because the Department of Government Efficiency violated FERPA and has my information, then I can get my loans forgiven automatically. Like, that was going around big. Like, we got questions asked, like, how do I qualify for this FERPA violation forgiveness? I'm like, that's not a thing. That is absolutely not a thing. Like, so that was a big one. Another big one is, oh, well, I don't have to pay. I'm sure LOs hear this all the time. I'm not paying my student loans. I'm not going to pay it. So why does it count towards my debt to income? Like, not understanding that actually, if you're not in repayment, it can actually hurt you, because then lenders have to use 1% or 0.5, which is often higher than people's actual payments, right? So this idea that I don't have to pay, it shouldn't count type thing is not real. Um, Also, in terms of like lender guideline issues or misunderstanding sometime is like, when is $0 actually be able to be used in Fannie Mae versus 1% because they're in forbearance? Like, there's a lot of confusion around that oftentimes, and it's not to the borrower, it's for the LO. LO's like, well, they have a $0 payment, we'll use 1%, not understanding that they actually have a $0 payment. So if we can document that they have an actual $0 payment for the next 12 months, I even have like a screenshot of what that looks like. And as long as the documentation does not say they're in forbearance, then you can use zero. And we've gotten that documentation for people. Even though they're technically in forbearance, we ask for a statement credit, and underwriting accepted at zero. And so they were able to get a Fannie Mae at zero, being in forbearance, because the letter just was like, as long as they have zero without it saying forbearance for 12 months, it's guideline compliant, and they accepted it, And so there's just definitely needs to be more understanding around what is a true $0 payment versus what's forbearance, and they're not making payments at all. There's a difference between those in the way that the guidelines recognize it. So I think educating LOs on that can help debunk some of the qualifications, because there's a huge difference. If someone has 80,000 in debt, you use 1%, that's using 800 towards their DTI instead of possibly zero, which can help them afford significantly more home, right? So I think we need to work on some of that sometimes with LOs, because there is some misunderstanding around what's a true zero that will actually qualify as zero. Yeah.
Yeah, and I mean, for consumers, I think a lot of people think that if they have any amount of student loan debt, they're not going to be able to qualify for a home, or and that for LOs who want to do some education, maybe on social media or in their classes, I think addressing that would be a really great thing to do. And Katie, that might be something that we want to do with First Home IQ, is just create some content, maybe with you, Kat, around like something loan officers can share around, if you have student loan debt, you can still qualify.
Yeah.
Here's how you do that.
Yeah, we have some of that already. So if you want to take that,
Yeah, let's do that.
Ben asks, average turnaround time 21 days or under is what we're working at. And honestly, we've been getting docs back within that time period, even through all these pauses that people are saying, supposed pauses. Obviously, we don't control the servicers, but what we found is when you make very specific requests, like borrowers, if they communicate themselves, will be like, I'm trying to buy a house. Give me the doc I need. That's very not specific. But if we are making a request on their behalf and we're very specific exactly what we need, we tend to get it because we're putting it in writing, you know? And there's a lot of paper trail with things in writing. So we tend to get everything done in our 21-day turnaround time. We were asked by April, I think, by the way, Melanie's on my team. So if she's answering questions in the chat, it's because she's very knowledgeable, FYI. But 249 or 3 payments of 89 is fixed. Wait, include fixing. What does that mean? Oh, include fixing the credit. We will make servicer. So what happens is once they purchase and move forward, they get assigned an advisor, and we will submit anything that they need to solve their problem so they can buy. So if that means submitting documents to their servicer to help with their credit, then that's what we will do. Yes, there is no other charge. Like straight up, there is no other charge. Like there is no hidden fees, or they can decide next year if they want us to re-enroll them again. We'll send them a reminder, their paperwork's due or their whatever's due, and they could decide at that time, but there's no like other hidden charges or something.
So I'd love to put the question out to the audience. If you can think about either if you've avoided working with clients who have significant or not even significant, but any student loan debt, and maybe ways that you've approached that. You don't have to put this in the chat or anything like that, but I want you thinking about how you could position yourself differently, I think, to capture this significant population. And Kat, I want us to also talk through.
Can I address that real quick?
Yeah.
So a great one is just thinking about niches, kind of like the ways big bank are like, oh, we do doctor loans. Forget about doctors. Like everyone's going after them. You could just be like, I am passionate about helping first responders. I'm passionate about helping teachers. I'm passionate about helping social workers. I'm passionate about helping nurses. I want to work with nurses. I want to work in healthcare, like whatever. Like if you create a niche that is not a super high earner where everybody's trying to chase their money, and you create, I am a like I want to serve first responders, like, and you create a niche and you can speak to their stresses on their job, speak to specific stressors they feel, then you have created a specialty for yourself that those are W-2 workers. They have stable incomes. We're always going to need them. That's a great way to get in with an audience that is pretty large. I don't know if you've ever talked about this, Kristen, but the majority of people employed in the United States actually work for government and nonprofit, because 86% of healthcare are nonprofit. And the driver of our economy, obviously, besides retail, is healthcare, schools, universities, local government. That's all public servants. So the biggest employers are not corporations, not top 100, not what we think is like these high earner, like corporates. They're really public servants, really, right? And so all those people have student debt, and they're very average earning Americans, right? And regardless of whether they work at home or they have to go clock in somewhere, I think a great way to create a niche to market isn't like I help every first time home buyer. It's like I'm passionate about helping these specific, not saying that that's all you work with, but if you get in with a really great group of social workers, even though they're not high earners, I'm telling you right now, they're going to tell everybody they work with. They're going to tell everybody in their professional associations. They're going to start telling everybody, because those type of, like, especially caring professions, they care about helping you as much as you help them, right? So I think caring professions are great niches because they will give back. They're not the type that is a taker. They're a giver too, And so I always promote people, if they want to niche themselves in a caring profession that's not super high earning where everyone's trying to chase them, So that's my marketing niche advice, even though we have kind of outside of lending, we do work with a network of PAs and nurse practitioners. Like we're kind of the go-to student loan service for this huge network. But yeah, those networks are really important, And so if you get in with those, you're going to create a great niche.
And you and I did a webinar a couple months ago around reaching Gen Z, and we talked about niching with influencers as well, like the micro influencers. And I think this falls right in line with that. Like this is, if you can, I think just the personalization attracts people to feel like they are understood. And so I love everything you said. And also, I think there's an opportunity there to find people that have a voice in that community, that are a leader in that community, whether it's online or in a community group or leadership scenario, and build a relationship there and, co-present with them or offer one of these, our first time like you presentation, that type of thing.
Like another thing, Kristen, as we talk about it, you as an LO could literally go to a micro influencer that only helps like basically people interested in getting their master's in social work. Like they might have a community of 10,000 people. You think a large lender is going after them to be like, hey, become my influencer? No, but 10,000 people for a single branch somewhere, it is a big audience. You know what I mean? And so like if you can create content that address some of their needs, like that's how we got in before we started working with lenders even. We got in with a lot of these healthcare micro influencers and these healthcare because again, caring professions are great. They're great at referring. They care, And so I just say that because there are a ton of like, hey, prepare for your master's in nursing influencers out there that talk about testing. They don't talk about financial literacy as much. So if you come and say, hey, I will create a marketing, this is what I can give back to your community and make it about what you'll give back to your community. They also care about making some kind of money. So that will be like, but it's going to be second or third in their caring of importance. Then I think you could create a great way to network with an influencer with an audience that's larger than yours. Even though in the YouTube world, they might be considered small, but to your world, they're still considered big, right? And so I think that that's a great way to get in with people who are very robust at speaking with trust to an audience online.
I love that. That's so good. And we had a great question from Katie that is, what simple pre-qualification questions could loan officers add to their process, specifically for clients with student loans, to identify opportunities earlier?
I love that question. Okay. And then I know Ben chatted one too. Just asking, what is your student loan balance? Simple as that. The minute it doesn't matter, public, private, it doesn't matter what their payment is. If they say their student loan balance, okay, so this is the rule. They say their student loan balance is $60,000 and their income is 50,000, 60, 70. As long as the ratio is like 75% of balance or higher relative to their annual income, that is definitely a person we're most likely able to help. So the rule of thumb is like 0.75%, 75% of their balance to income or higher are definitely people we're going to get the highest and best results with, which you'll be surprised. It's not a small group. It's a pretty large group because now they're saying people are coming out with more debt, especially for master's degrees. And a lot of people are going back for their master's online even, are coming out with more debt than income in first year, regardless of the degree type. They could be studying film or getting their MBA. It does not matter. People are coming out with more debt than they're going to earn in their first year. And so asking, do you have student loans? What's the balance? That's the only qualifying question. The minute they say that, that they have some type of balance that looks like it's going to disturb their debt to income, and you can speak to that, that will already make you so much more competitive relative to another lender who can't say anything about that stressor they're having. Because trust me, it's causing stress,
Okay. Okay, so I want to make sure we address any questions you guys have in the audience. Here's a question from Lynette. Would this strategy process help the score of a co-signing parent on that student loan?
Well, first of all, there's very few loans with co-signing parents. Very few. Most parents take out Parent Plus loans, which now the loan is in their name. So if you're trying to sell to a parent who wants to go get that second home now and they have mounting student loan debt, We have our refinance partner. If their children are now out earning money and successful, we'll even refinance and put it in their children's name to get rid of that debt in their name so that their retirement is no longer threatened, because that's what's happening to so many people, right? So I'm talking about the flip side. Very few people have student loans in undergrad that are co-signed by their parents, because the federal government doesn't require that. It's in their name or it's in their parents' name. There is no co-signing in federal student loans, and that's 92% of all loans. So I just want to clarify any misunderstanding. If there is a cosigner, it's because the loan's already private, and that person didn't have the best of credit score, so the parent cosigned. But that's like under probably 3% of all loans. So I just want to clarify that. I also don't want to forget, Kristen, Ben's question about, is there option to split costs between LO and client? There are some lenders that can offer a credit at close. They don't say anything about Loansense. They're just like, hey, if you pay for this process, I'll offer you X credit. That's a way to cover whatever costs you feel like, without directly interfering with the Loansense process. Yeah. So I hope that answers that question.
We have a couple other questions coming in. One from Mary. Is there still any chance of forgiveness given some applications that were completed in a window that was being offered?
Yes. Forgiveness is legislated by Congress under law that cannot be taken away. So forgiveness exists. And in fact, if someone's in process of forgiveness and it hasn't been forgiven, they need to get the docs from their servicer. So if it's on the pathway of forgiveness within the year, underwriting guidelines state that it does not have to be counted towards the DTI. So if we get the docs for you, does not have to be counted towards the DTI. Let Loansense worry about how to get them forgiveness, because that's what we do, okay? And we will get them the forgiveness. And it's still there because, again, the only change that can happen is if Congress says we want to get rid of loan forgiveness, which will not happen because entire hospital systems use public service loan forgiveness as a benefit to their nurses and doctors to attract them over private practice. So it is not going away. It will not go away. There's too many interests. The teachers union, super interested in loan forgiveness, and they're already fighting and suing the government for stopping enrollment, right? So loan forgiveness is not going away. No matter what you hear, it's not going away because Congress there's not political will to actually make it go away. There's only talk because there's always talk, right? But whether they're going to congressionally get it done, even more conservative people in the Republican Party have too many healthcare people paying their bills, really. So it's really not going to go away. So I would not worry about that. Again, let us help you get the docs for mortgage close, and we will worry about getting your clients forgiveness. Let us do that. We're really good at it. We're really good at it. I don't know what else to say. We get people forgiveness. That's our job, because again, we're not paid. We're paid to do what's best for them. And for them is to get forgiveness. We don't get paid a servicing fee. Like if they stay paying forever, we make money. Like our incentive is not disaligned with theirs. So that's our job.
We had a question from Amy. Do you know what the kids in the SAVE plans are supposed to be doing about their current income-driven plan?
Yeah, that was another news update that we didn't quite get to. So I'm really glad about that question. Okay, so options for SAVE. We enroll them into a different income-driven plan. That's what we do. Technically, income-driven enrollment is no longer paused, but things, quote unquote, move slower. If they do it themselves, they will for sure not hear back. If they let us do it, we will likely enroll them into something else, get the documentation for close, and then we will work on getting them into another income-driven at a different date. The point is, we will get them the docs they need, right? Melanie, did you have something to chime in? Oh no, you're answering another question. Sorry. But if you have anything to chime in on the enrollment into anything else besides SAVE or income driven, we can get them out of zero is the point. Or get the docs that are going to get approved at zero. Like we submitted something March 7th and we got a doc back March 21st with a borrower. It's basically called a statement. Melanie, what was it called? It was called a statement balance, and it showed 13 months at zero. It did say nothing about forbearance. Underwriting accepted it. They got approved. Fannie Mae $0 payment. Okay, so there we can either navigate a $0 payment or re-enroll them into something else that's slightly higher than zero that actually shows a payment. But either way, we can help get them out of like the zero and using the 1% rule, if that makes sense.
So as we're kind of starting to wrap up, you guys continue to type your questions in. We can also take you off mute and have a conversation here. But I do want to make sure, you had mentioned freebies, scripts, things like that. And especially with our focus at First Home IQ, helping people as they're, starting their financial journey all the way through buying their first home. I'd love to think through what are some scripts that would be helpful for loan officers to take to their database, and as we're thinking about, or other scenarios that we might think about other than those who are already ready to buy.
Yeah,
That
I
would
think,
help
okay,
people.
so this is what I'm going to get right away. I'm going to chat from my presentation we never did, which is fine.
Yeah, feel free to share slides or whatever too.
Right. I don't think I need to. I just want to chat this because people are going home about the freebie. I would never want to leave without offering it. So let me chat it here. There's a couple things I'm putting in here. Demo. I say come to a demo because if you want to understand how to sign up for a product, which by the way, our product to invite people is free. If you think you have a really good use case where you want to run 500 people in your database from the last year who's made some kind of inquiry, didn't move forward, now's a great time. Some of them have debt. You want to figure out how you can get Loansense to help with that. Please come to our demo. Because then we can also give you some scripts. But I do want to give you a freebie because people are asking, right? This freebie, if you click on it, we will have a borrower level testimonial that is real. That is real about what happened. It's not made up, that we disguise their identity. The testimonial of the LO, here's one that was branded by a loan officer at Mortgage One already. But if you go up, we have the original LO who that's his client. The testimonial is also real. The impact is also real. All of this is real, but the reason why it's a great freebie is you can put your own face, go sign up for Loansense, learn about it. You can put your own face and you can start speaking to the pain points borrowers have. You can change the number. You can change really anything. We have very specific things. We guide you. And if you go up real quick, can you scroll up real quick? Kristen, whoever is sharing the screen, Kristen is. Okay. We will tell you exactly what to change, right? And you have a sample at the very bottom. Just do us a big favor. Don't delete the guides because other LOs will need the guides. For a couple LOs went in and started deleting all the guides. What we recommend is once you do yours, you can export it out or download yours and leave it and or delete it, whatever you want. Just don't delete the guides because then it makes the guides unavailable for other people, right? So you can create yours, download it, and then delete it, or you could create yours and export it, right? So whatever you want to do, just don't delete the guides. And then once you generate your own dashboard, like you can come to a demo, learn more how to do that. Super easy. You just go to lender.myloansense.com. It takes 2 minutes to sign up. You literally give us your NMLS, a few details, and then you get your own specialized links. You literally then can put it in the flyer for people to go to your links. You can give this out to realtors. You can put it at the bottom of emails once you find people in your database with student loan debt. You don't even need to let us do any complicated debt crunch if you don't want. You can literally just go back to the credit reports in your LOS of clients that had educational trade lines and literally use an email template and send them out your Loansense link and they can start estimating the reductions, So there's all kinds of things you can do, but I first invite you, if you are interested and want questions answered, how does our product work? How do you sign up? How exactly does the pricing work? Because we didn't get into that. I'm not trying to sell our product. I'm actually literally just trying to offer some free resources here. So if you want to learn more about how to more effectively use it, definitely come to our demo, but take this freebie. And this is a great freebie to communicating the impact and the process to the borrower.
All right, awesome. Well, this has been such a productive conversation. I know I've learned a lot, and it's been really great for you to share some of these updates and strategies. I'm excited about what we're going to do together and creating some of that or sharing some of that content with our First Home IQ ambassadors and community. So everyone keep an eye out for that. Kat, any last words? And thank you so much again.
Well, just let us know, like ambassadors, let Kristen know what you want. We have a lot of resources in our learning center. So we already have a lot of content. Let Kristen know what you want, and we're happy to share it for any ambassador. Yeah, we have a certificate training program as well. That's part of our premium program. But again, we're happy to offer it to First Home IQ loan officer. So just let Kristen know what your interest is, and we are as good as we know what you want, and we will give it to you.
Perfect. Same here. If you guys are not ambassadors, I know we have a lot of ambassadors on the call today, but if you're not in the program, we offer resources and a strategy call every single month, and a lot of support around helping you reach the next generation. So definitely check out firsthomeIQ.com/ambassador if you are not an ambassador yet and interested in joining. And we will be adding these resources to that community as well.
Can I just add one other thing? I just want to add one other thing. We have a YouTube channel. We're not YouTube influencers or anything, but we have a YouTube channel that we post to practically every week with amazing video content. I say that because even if you don't want to create your own content around this, or you want to create it, you don't know what to talk about, just copy me. I talk about it every week. Copy what I say. I mean, not word for word, put your own personality, but there's a lot that I talk about. If you want to address this audience, just follow me on YouTube. Just type in Catalina Loansense YouTube. You'll find me. I tell my story as the intro. Subscribe to my channel, and every time I put out content, just take it and use it for your own, or just send out my links or make your own, But the point is, you don't have to be generating content all the time. Just take other people's and make it your own, and you'll be talking to an entire new audience. So I just wanted to say that and offer that as well.
That's another thing we can add to this playbook around, creating content specifically for this audience, sharing that education, building trust. So thank you so much, Kat, for all the ideas and resources. And we're so happy to have you part of this community.
All right. Thank you.
Thanks, everyone.